Working capital management is the process of managing a company's short-term assets and liabilities in order to ensure that it has enough cash on hand to meet its financial obligations. The two key components of working capital are current assets and current liabilities. Current assets are assets that can be converted into cash within 1 year, such as cash, accounts receivable, and inventory. Current liabilities are obligations that must be paid within 1 year, such as accounts payable and short-term debt. A key metric used in working capital management is the current ratio, which is calculated by dividing a company's current assets by its current liabilities. A ratio of greater than 1 indicates that a company has enough assets to cover its liabilities, while a ratio of less than 1 indicates that a company may have difficulty meeting its financial obligations. Effective working capital management involves finding the right balance between maintaining enough cash on hand to meet financial obligations, while also investing in growth opportunities. This can be achieved through a variety of techniques, such as managing inventory levels, extending payment terms to suppliers, and negotiating better terms with creditors. One of the important aspects of working capital management is accounts receivable management, which involves managing the credit policy of a company and monitoring the customers who owe money to the company. This can be done by credit analysis, credit limits, credit terms, and follow-up on overdue accounts. Another important aspect is inventory management, which involves managing the level of inventory and ensuring that inventory is not overstocked or understocked. This can be done by forecasting demand, setting reorder points, and implementing just-in-time inventory systems. In addition, managing cash flow is a critical component of working capital management, as it ensures that a company has enough cash on hand to meet its financial obligations and take advantage of growth opportunities. This can be done by forecasting cash flow, managing debt, and implementing cost control measures. In summary, working capital management is the process of managing a company's short-term assets and liabilities in order to ensure that it has enough cash on hand to meet its financial obligations. It involves finding the right balance between maintaining enough cash on hand, managing accounts receivable and inventory, and investing in growth opportunities. Effective working capital management can help companies to achieve financial stability and growth. Thanks for watching another episode of Finance in 2 Minutes, where we make finance less boring than staring at a tax form. But before you go, don't forget to hit that subscribe button and join the Fast Track to Financial Literacy Squad. Because let's face it, if you don't invest in your financial education, you'll end up like the person who thought Bitcoin was a typo of biting coin. See you in our next 2 minutes video.